e-Forex trader speak and fxstreet.com would love to welcome Todd Gordon of Forex.com in the United States at this Barcelona event, the 10th anniversary of FX Street's Traders Conference. Todd, welcome.
Thank you. Nice to be here.
Todd, tell us a little bit about your background and how you came to be a teacher and a Forex analyst.
Yeah, sure. My trading career started out short-term trading the stock market, and this was just after the bubble popped. We had a lot of volatility. If you remember the WorldCom and the Enron crisis, that created a lot of volatility. So we're short-term trading the equity markets. As the markets bottomed in 2003 to 2004, a new uptrend began. Volatility really kind of came in, and what you see in higher uptrend markets, these risk-on markets we're talking about, you see lower volatility. So the short-term intraday game of stock trading really kind of went out the window. So my mentor, boss, and new business partner, Dave Floyd, got me into this FX thing. So I think it was 2004 I started trading foreign exchange, and I found out that it's a much different game than short-term trading the stock market. So,
what is the difference?
Well, it's more of a thinking man's game. You know, we have major market centers. It starts with Asia, and it goes into Europe and London, and back to New York. So there's three major market centers that are all feeding off each other about what the tone was into the close of one market will carry over. Economic data carries over, much more so than when you see intraday in particular equities. So it's a longer-term market. Trends tend to last for longer periods of time in the FX market than they do in the stock market. So you need to stretch out your time frame a little bit, and you're going to see higher volatility levels. So you need to be able to control risk a lot better in the FX market. So there's definitely an adjustment between going from stocks and futures, which I think a lot of the traders do, start in either equities or futures or maybe even options, and they get in the currency markets. You're going to make some adjustments.
Right, and you were obviously enthused. You don't trade stocks anymore. You're purely FX now?
Purely FX, but you know, it's a cool economy we're in these days because you need really good knowledge of the four major asset classes to trade FX. You can't trade FX just in a bubble. You need to know where commodities, equities, and fixed income, where those markets are, to effectively trade FX. You really can't trade the dollar or any of the major GA currencies within a bubble.
So are you a fan of the sort of intermarket type?
Absolutely. It's great. I mean, that's how I start my trading days. You got to know I'll take you through the way I start my days. You got to know what pairs are.
So this is your approach?
This is my approach. Right, this is how I sit down in the morning and say, listen, I know it's a dollar day, it's a euro day, euro higher, euro lower. You need to tone. And if you know it's a commodity, you see the Aussie group and the Kiwi group in Norway, you see those commodities a little stronger, and you see dollar, yen, and Swiss weaker, you know what? First off, it's probably a risk-on day. And if it's a risk-on day, you're going to look to the equity markets, you look at the commodity markets, you're going to expect to see strength. If you see strength there, you're going to expect to see bond market weakness, which would mean interest rate strength. And in the currency markets, you need to know which currencies are going to respond well to a stronger copper market, or a lower Japanese bond market, or a higher Chinese stock market. Like I said, the intermarket analysis, and like you said, Larry, the intermarket analysis is a really important part of trading the currency markets.
And where do you work now?
I'm the senior technical strategist for Forex.com. New York City. Our office is on Wall Street. So
you work out of Wall Street, or?
Yep.
Okay, and do you trade the London session and New York session?
My style is, as I'm progressing as a trader, I guess I'm 10 years now as a trader. It's still, you know, relatively younger compared to most people in business, but kind of my style is still progressing nonetheless. And what I'm finding is interesting. I've been talking to a lot of the traders here at the FX Street conference, and I've relayed a story that, you know, as my trading for the fund has gotten older, it's interesting. My size has gotten smaller.
Right.
It's actually, my size is a half to almost a third of what I started trading.
And what kind of gearing do you employ?
But the thing is, my stop loss has become 2 to 3 times larger. So I've found that I think the better chance you have to stay with a winning trade or cut your losses in terms of having smaller positions. I think you have a better possibility of staying with longer term trends. So I've actually found to be more productive to be in longer term trends with smaller size than banging your head with big size. So I'm sorry, what?
I apologize for interrupting.
Sure.
You mentioned a fund. Do you run a fund?
I formerly trade for Gain Capital Asset Management, and believe it or not, I'm leaving this month to begin my own venture. So actually, as I speak now, this will be my last month. But yes, I'm moving into a future asset management program.
Okay, and do you have a name for that yet?
As of now, it's still in production, but details to be released.
Watch this space, all right?
Exactly.
Okay, and give us a little bit of perspective about, you know, what kind of gearing you would recommend for, say, the average private trader with, say, a 10 grand account, and the kind of trades you would put on intraday. Are you discretionary? Are you fundamental? Are you both? And so forth. Your trading approach.
Yeah, absolutely. I mean, my approach is to, you know, bet the farm in every trade. No, just kidding. No, my approach is completely the opposite. You know, my style of analysis and the way I look at the markets as I began the interview is, one, to understand what major markets are going to impact your trading market. You're going to lead or lag. And then the second style is you need to quantify risk before you go in any kind of trade. You need discipline, a form of pattern recognition. Pattern recognition is going to tell you where a trend should begin and a trend should end, where a correction should end. There should be starting points at both market phases. The starting and ending points of those market phases become your trade entries and your trade exits. Okay, my particular style is Elliott Wave and Fibonacci theory. Once you've done the intermarket analysis work, move to Elliott Wave and Fibonacci. And for me, there's no better style out there in the world, no better methodology to understand when a trend should end, when a trend should work. And the good part is there's expected levels that the trend should begin, trend should end. Those become your stops, those become your limits. So it's got a built-in dimension of trade management in terms of risk and reward. So I'm purely discretionary. I overlay the intermarket analysis. I quantify patterns with Elliott Wave. It's not a system. It's a methodology. It's a guide. It's a framework in which you need to operate in trading.
So it's pretty technical, right?
It's technical, but it gives it's just about 13 rules that you need to follow that won't allow you to get too far out of the trend. It won't let you turn a loser, which should be a normal 25, 50, 75 pip loser. If you're obeying the rules of the methodology, a loss should never get away from you. And if you are trading well, then that profitable trade that you're scaling out of, perhaps you can hold that last unit for the upside ultimate fit projection to really get a nice winning trade. So it's a guide. It provides a nice framework for you to kind of operate your trading in and not get too far on either side of the in terms of volatility.
Do you use Fibonacci extensions?
Absolutely. There's the 3 Fibonacci tools that you use within Elliott Wave, and each of the 3 Fibonacci tools has a specific spot within the Elliott Wave sequence. So there's expected fib ratios that you would like to see in waves 1 through 5, waves A through C. So as I said, there's no better system or methodology that'll tell you that this is likely the spot you are in the trend. And when you see the market reverse on a level you anticipate, then your understanding of where you are on the market is increased. So for me, it's a great way for me to, kind of a hyper guy like me, to stay a little disciplined, prevent over trading, and quantify risk before you go into the trade.
And do you use any specific software, or do you just do it manually?
I use e-Signal right now. I use
Advanced Get?
Not Advanced Get. I'm a big believer in the if you look back at the golden age of technical analysis, Elliott Wave Theory was actually invented by R.N. Elliott in the, I believe it was the late 20s into the 30s. He had a bunch of hourly Dow close charts scattered all over his porch. Technical analysis in the 60s and 70s and in the 80s, before charts became prominent, was done by hand. And if you talk to some of those traders or read what they've written, there's really no better way to become intimately familiar with price action than to do it by hand.
Right.
Okay? Too many people rely on automated analysis of the markets, and you don't really get a feel for what's going on behind the scenes of the market. So for me, I do all the wave analysis, all the analysis that I do by hand, and it really gives you confidence that I know where the market is, I know where it's been, I watch it trade, my analysis will flow with the market, and that will set in your brain and really give you a good feel, kind of a tape reading approach to the market. So it's important you do it by hand, in my opinion. So no automated software for me.
And what markets do you mainly trade?
I trade mainly the G8 against the US dollar, trade some of the crosses. I like the Aussie against the yen. Right now I'm actually in a long euro against the pound position. Some big news out of the UK today that makes me want to be short short sterling relative to euro.
Right.
Some good examples in here in terms of, like I said, really reading the tape. There's a lot of economic announcements. China just raised interest rates for the first time in 3 years. We saw a sharp reversal, lower in equities, higher in the dollar, that lasted all of 12 hours, and now here we are the very next day, stocks are breaking out, dollars on the low. So it's really kind of a nice example of it's hard to fight the trend even when you get markets got very emotional. You could feel it yesterday.
And where do you see the Forex markets developing on the broking end and on the trading end in the next 2 to 3 years? We've seen tremendous competition now.
Yeah, competition's great. I think it's the maturity of the industry, it's the evolution of the industry, and I think our goal as FX traders is to get it on the same plane as fixed income, as commodities, and as equities. It's going to be the fourth major asset class, should be an investable asset class, and I think if you know, as I said, anything about watching how the major markets trade together, the dollar with equities, interest rates with the yen, if you see it does fit into the major asset class flow of the world, so I think it needs to be an investable asset and considered an asset and nothing, the days of get rich quick and too much over leverage, I think those days need to go, and it needs to be accepted as another trading vehicle.
All right, Gordon, thank you very much. I appreciate it.
Thanks, Larry.
Thank you, sir.